There is kind of a framework that is commonly used by businesses, like large businesses, called the COSO internal control framework. Okay, so let's just talk about what the different um, elements are. And it spells crime, CRIME. So it's kind of easy to remember. So the C stands for control procedures. So these are the things that are actually implemented on the ground to um, like their business processes. For example, um, if you have your inventory coming into your warehouse, you will have a system in place where the employee who's there at the warehouse will have some documentation, like a purchase order. They're then uh, instructed and trained to look through what's arrived, check it against the receiving kind of the purchase order. They're going to write down exactly what was there, what was received, a manager signing off. So there's some kind of supervision. All these things are procedures, right? Or like if you're tracking your employees' time cards, okay, there will be a procedure where you have to clock in, either using a thumbprint or some way to clock in and clock out. And the way that information is then given to the accountants. All these procedures are actually put into place to kind of within your operations. And the better your controls are, the more thorough they are, the harder it will be for loss, theft, fraud, all that stuff to happen. But this next one is related to kind of, you don't have infinite resources and manpower, money to put crazy amounts of control procedures into everything. Okay, so you have to figure out what parts of your business are actually vulnerable. And that's what this risk assessment is. You're going to look through all the different parts of your operations and determine where the risk for fraud, misstatement, mistakes, all that stuff happens. Okay, so that's actually an important part of prioritizing where you're going to spend more time with putting in more strict or less strict control procedures. I is its own thing. Information systems now in the modern era, everything is computerized. Like even small businesses are totally reliant on kind of computers and computing to manage their business. So having internal controls on just the information system is really important. Like for example, we all use like let's say you're entering information into some website and you put in something and it like doesn't allow you to submit it and it gives you an error that says, hey, this is not formatted right, or hey, you forgot this. That's an example of an information system control. It's not allowing you to kind of input information into the information system without certain checks. Okay, so because again, information systems are so critical to a business's operations, it's like its own category of control procedures. Okay, so now you'll start noticing it. Like whenever you use websites, these are like widely implemented, and even like how you shop online and at work, if you use a computer system, it's gonna throw errors and like not let you do stuff unless it's formatted correctly, it's complete. Maybe there's going to be some level of sign off, like if you submit something, it has to get approved by someone else. These are all happening within the information system. M, so you can set everything up, but if there's no one or no way that this entire thing is monitored, then it can maybe be failing in ways and not really be working as intended. So you have to have some ongoing monitoring system in place. And then E stands for environment. And so this kind of goes to like the culture of the institution. Okay, there are some companies that maybe set up stuff just for like window dressing and they don't really care about following it, while some businesses are really emphasizing in their culture of following procedures and kind of managing risk. Okay, so this environmental factor is actually really, it's like, we may have laws, like you can even think about this, like if you live in a city, right? There's laws against certain things, but if there's no enforcement of it, then like there's no point in even having the law, right? So the environment of like how seriously internal controls and like risk management are, that's going to vary between businesses. Okay, so of course, if you want to do a good job and manage your risk well, you're going to have a culture in your company that emphasizes that. Okay, so making sure that environment, that kind of tone of management is there is also important, just as important as like all this technical stuff. Okay, and then the auditors are here to kind of ensure this whole thing is working correctly too. Okay, and there's external and internal auditors. Um, within a company, there will be like usually for large businesses, people that work for the company that are in charge of auditing and making sure things are working correctly and there's no fraud and like whatever. They're going to be investigating to make sure things are working within the parameters of this kind of framework. Uh, they have a special privilege of reporting directly to the board of directors. Okay, so we talked about the hierarchy of in a corporation. The shareholders are at the top. They're the owners of the business. They appoint a board of directors, and then the board of directors, they're kind of they're like looking over the CEO. So the CEO of the company has a boss too. It's the board of directors. The board of directors have a boss who are the shareholders, right? So the internal auditors usually don't report to the CEO. Okay, they're directly liable to the board of directors. Okay, because the CEO may be the one committing the fraud, right? So it wouldn't make sense for the internal auditors to report to them. They're going to report directly to the shareholders. I mean, not directly, but to the shareholders' representatives. Okay, because they're looking out really for the shareholder. The CEO is supposed to be, but oftentimes CEOs also have conflicts of interest. They want to kind of, they have their own self-interests that are in conflict with the company. Okay, so they could also be the root of some problems. External auditors, they have their own conflicts though, because usually they're paid by the company. So if the company as a whole is doing something wrong, that could be a problem too, which has been a problem in the past with auditors. Um, but now there's some rules in place to help mitigate that. But really, the job of the external auditor is to be a third party that has no skin in the game, that's able to fairly report to the public what's going on with the company. That's the theoretical kind of role of the external auditor. This is all set up. I don't know. This is like kind of historical information. This COSO organization uh, is a result of some government action that happened in the 1980s. Um, and I guess there's probably some frauds that were happening at the time. Usually, all these things are in response to some scandals. Okay, so the whatever was happening in 1985 in the financial markets probably caused the government to take some action, and they came up with this framework. Okay, and now this organization COSO is still kind of in charge of like you know making all the details of this framework that companies are supposed to implement. Okay. Also related, another law that was passed in response to some financial scandals was the Sarbanes-Oxley Act. What was happening in 2001? Many of you were probably either not born or anyone know what was happening in the late 90s and then it kind of ended in 2001. Yeah, the dot-com bubble. Okay, so that was one big kind of hit to the financial markets where you had this huge run up in stocks, and particularly in stocks related to like like the internet, because the internet was like really new at that era. But there were really two main like accounting frauds that happened. Enron was a big one, and WorldCom. WorldCom was actually, you could consider a tech stock. They were involved with like fiber optics and like laying kind of the infrastructure for the internet. Enron was like an energy company, so it was kind of unrelated. But they were really two really big financial scandals where the companies were like kind of misreporting, or like, they were doing very aggressive stuff. And I think we talked about Enron a little bit in a previous lecture. Um, but in response to that, because so many investors lost money on these scandals, the government, again, instead of preventing things, they're just kind of fixing the last problem. They passed this law. And so the key parts of it are executive accountability. So that means that the CEO and the CFO, like basically whoever is signing the financial statements every quarter for the company, they could be criminally liable if there's any like serious fraud. Okay, so now there's like skin in the game, right? The CEO and CFO, they could go to jail if things are like very wrong in the financial statement. So this is trying to create an incentive for companies not to like be very uh, overly aggressive, or like clearly or fraudulent in their reporting. Okay, um, because you could argue that Enron was within the bounds of the law, but they're just so egregiously aggressive in what they were doing that it rolled into being fraudulent. Okay, so this law was meant to make the executives think twice about being overly aggressive in how they presented their financials, because they could go to jail. And there have been prosecutions of CEOs and CFOs under this. Okay, so I don't know how well it's worked because there haven't been like a ton, but there have been some. Um, Another thing is the internal controls. Now the auditors have to not only check the financial statements, they have to check and make sure the internal controls are sufficient within the business. Okay, because you could argue that if their internal controls are not good, then the whatever is coming into the accounting system is also going to be wrong. It's like garbage in, garbage out. So Sarbanes Oxley, it forced the auditors not just to look at like the ending balances of the accounts and like kind of look at the accounting system. Just they have to look at, are they doing a good job with receiving? Are they doing a good job with all the stuff, right? Like how good are their systems set up to make sure what's going into the accounting system is correct? Okay, so this was like a big jobs program for the CPA firms because it vastly expanded the scope of the audit that they have to do every year. Okay, so this created a lot of work for CPA firms and a lot of fee income for them. So, I'm sure that they were happy about that. But it's like an extra expense for the company, extra headache to deal with. Um, the auditors also became a little more scrutinized because you can argue that Enron and WorldCom, these financial scandals, they were enabled by their auditor, because really the auditor has to sign off and say whatever they were doing is okay in this like opinion letter that they give every year. Okay, so the fact that the auditors allowed these things to happen also was an indictment to them, because their whole job, the why they exist, is to prevent these types of things from happening. So if they screwed that up, the question is why. And one big part of it is that the auditing firms who are paid by the companies, they have multiple business lines, because not only were they doing financial audits, they were doing like business consulting. So they didn't want to make the company unhappy, right? If you don't want to make the company unhappy, then you're just going to kind of give them what they want, right? So that's why in this act they try to separate the audit kind of function from all the other business consulting that these firms were doing. And they also made them rotate. They had to rotate partners. So if a audit partner had been working on some company for some time, they had to switch to someone else so that they didn't become like homies with the executives. Because you got to have some adversariality. You got to have the CPA be adversarial to the company. Their job is to regulate, is to like make sure they're doing a good job for the benefit of the public, right? So in order for that to be achieved, you have to like they can't be homies with each other. They got to be a little adversarial and not adversarial in the sense of like hating on each other, but like they can't be so close as to allowing the business to influence the judgment of the audit partner, okay, or the whoever whatever CPAs are in charge of the audit. Okay, so there are some rules that were put into place for that. Um, so what has been the impact? So again, it's been like whatever, over 20 years that this law has been in place. It has boosted the cost of compliance. Okay, so if you're a public company and you have to adhere to this, you're spending a lot more money than you were before on CPAs. Okay, um, so that's one thing that, of course, not only affects the business, they have to hire people to kind of deal with the extra burden of the compliance. It's just an extra cost to the shareholders. Okay, so the shareholders are paying for this. It could be argued, and it's hard to tell these things, right? It's hard to tell whether it has like made an impact because you'd have to have two parallel universes where you have one without this act and one with to see what the difference is, right? So you can still say, hey, we still have fraud and there's still financial scandals, but would it have been more without this? I don't think it's really possible to say, okay, definitively. This is all opinion. Okay, so those who are regulators will say yes, it has. It creates the right incentives. Okay, while some might argue like no, we still have big scandals and it doesn't work. Okay, but the truth is probably somewhere in between. It's probably a little bit of both.